Emerging markets came sharply into focus in August, with Turkey leading the way. Turkish markets started to come under pressure in July following the appointment of President Erdogan's son-in-law to oversee the economy. But things escalated dramatically in August as the US imposed sanctions as a result of the continued detention of a US pastor in Turkey. With markets looking to Erdogan for a plan at his mid-month address, he squandered the opportunity to act, and the Turkish lira duly fell 13% on the day, to increase its year-to-date decline against the US dollar to 40%. As liquidity flooded from emerging markets, investors began to question the ability of Argentina to refinance some of its debts falling due over the course of the next year, and it was forced to approach the IMF to plead for early access to funding lines, further exacerbating EM fears. EM problems spilled over into European markets, predominantly via the European banks, which have material lending into Turkey. To make matters worse for European markets, Italian Deputy PM De Maio, who represents Italy's anti-establishment, threatened tough negotiations with the EU over budget restrictions and migration. On the other side of the Atlantic, the US stock market showed resilience as the second quarter earnings concluded during the month, with reported earnings growth of over 25% year-on-year. In a repeat of what played out this time last year, FANG stocks, together with Microsoft, have delivered half of the S&P 500 returns for the year. Heightened risk aversion kept a lid on interest rates, with US 10-year bond yields falling slightly for the month, but credit spreads for both investment-grade and high-yield bonds were mostly stable. In a familiar theme for the month, it was the EM bonds that had the biggest moves, with the JP Morgan index of local currency EM bonds down 7%. If you have any questions on this or to invest with Anchor, please contact us on sales@anchorcapital.coza or visit our website www.anchorcapital.coza.